Most stock market investors only know how to profit when share prices rise. There's a second way, and it's how the people who manage the most money actually think. The strategy is called short selling. You make money when a stock falls. The bigger the drop, the heftier the profit. It's not illegal, it's not gambling, and it's not reserved for hedge funds, though they use it every day. It's one of the most misunderstood tools in finance. So let's walk through it, how it works, why it exists, and the one risk inside it that most people never see coming. Normally, when you invest, you want the price to go up. Buy low, sell high. That's what most people learn first. Short selling flips that. You want the price to go down? Here's the everyday version. Your friend has a bike worth $100 today. You think it'll be worth $60 by next month? So you borrow it, your friend agrees, knowing you'll sell it and return an identical one later. You sell it now for $100. A month passes, the price drops, and you buy an identical bike for $60. You hand it back to your friend and keep the $40 difference. That's the shape of the trade. In the stock market, you do the same thing with shares of a company instead of bikes. Say Company X trades at $50 a share. Your research says it's overvalued. So you call your broker and borrow 100 shares. They facilitate this through securities lending, loaning shares from their own inventory or from other clients who own them. You sell those 100 shares immediately for $50 each. That's $5,000 in your account, but the money isn't really yours yet. You owe 100 shares back. Weeks pass, the stock falls to $30. You buy 100 shares at $30, $3,000 in total, and return them to your broker. You collected $5,000. You spent $3,000. You keep $2,000. Same trade as the bicycle, just with shares. Hedge funds short stocks every day. It's how they stay positioned when markets fall instead of just hoping they don't. Professional traders use it as part of a wider book. Long on companies they believe in, short on ones they don't. The shorts hedge the longs. If the market drops, the long positions lose, but the shorts gain and the damage is contained. Institutions short to protect existing holdings. If a pension fund owns a huge position in a sector and worries about a short-term decline, a targeted short can soften the loss without selling the underlying position. And yes, retail investors short too. Brokers like Interactive Brokers, Fidelity, and Charles Schwab all allow it once you've opened a margin account. Whether you should is a different conversation, and we'll get to it in the next section. Here's what separates a short from a guess. The short seller has done the work. Read the 10K. Track the cash flow. Notice the inventory that keeps growing while sales don't. Found the executive quietly selling shares. Spotted the valuation that only makes sense if everything goes right forever. Then, and only then, the position goes on. Now the part nobody can afford to skip. Short selling carries a kind of risk that doesn't exist in normal investing. And it's the reason careers end on this trade. When you buy a stock the normal way, your downside is fixed. Put in $100. The worst case is the company goes to zero and you lose $100. The floor is real. Short selling doesn't have a floor. It has a ceiling, and the ceiling is infinity. Picture the trade going the other way. You borrow and sell 100 shares of Company Z at $50. You collect $5,000. But instead of falling, the stock doubles to $100. To return those shares, you now have to buy them back for $10,000. You collected 5, you spend 10, you lose 5, and it gets worse from there. A stock can keep climbing. There's no rule that stops it at double. It can triple, it can 10x. Volkswagen briefly became the most valuable company on earth in 2008 because short sellers were forced to buy at any price. Some of them lost billions in days. So one line to carry out of this section: long positions have a floor, shorts have no ceiling. That single sentence is the entire risk profile of the strategy. Anyone who shorts without internalizing it is going to learn it the expensive way. Here's a perspective most people never consider. Short sellers actually keep markets honest. Without them, every market would be a one-way street. Only buyers, only optimism. Prices would float higher and higher with nothing pulling them back to reality until the eventual crash, much later and much worse. Short sellers create the counterpressure. When they believe a stock is priced for a future that isn't coming, they short it. That selling drags the price closer to what the company is actually worth. Painful for shareholders, but functional for the market. And sometimes they do more than that. They expose fraud. Jim Chanos shorted Enron in 2000, a full year before the company collapsed, because the accounting didn't make sense. Years of Financial Times reporting and short seller pressure exposed Wirecard, the German payments giant, as a multi-billion-dollar fraud in 2020. Muddy Waters Research published a damning report on Luckin Coffee the same year, showing fabricated sales numbers across thousands of stores. More recently, Hindenburg Research exposed major accounting irregularities at companies like Nikola and Adani Group. Each time, the short sellers were right. Each time, the rest of the market was the last to know. Short sellers aren't doing this for the public good. They're doing it for profit. But the side effect is that fraud sometimes gets caught earlier than it otherwise would have, and the market gets a little more honest in the process. This is where shorting can detonate. The setup is simple. Imagine a stock that thousands of traders have shorted. Everyone agrees it should fall. The short interest is enormous. The trade looks like free money. Then the stock goes up. Maybe earnings beat. Could be a short squeeze rumor. Could be a crowd on the internet deciding this is the hill. Whatever the trigger, the price moves the wrong direction, and every short seller in the stock starts bleeding. Remember the math from the risk section. The higher the price climbs, the more it costs them to close out. So they start buying back shares to cap their losses. That buying pushes the price higher, which forces more shorts to cover, which pushes it higher still, which forces more shorts. Each wave of buying creates the next. That's a short squeeze, not a normal rally, a forced rally. The price isn't rising because the company got better. It's rising because shorts are being marched out of the position at gunpoint. The most famous one in recent memory is GameStop in January 2021. GameStop was the perfect setup, oversold from a long decline and overshorted to the point that short interest hit roughly 140% of the float, meaning 40% more shares were sold short than actually existed in the open market. A crowd on Reddit's Wall Street Bets noticed, started buying, and the squeeze went vertical. The stock ran from around $20 to nearly $500 in less than 3 weeks. Melvin Capital, one of the hedge funds caught on the wrong side, lost roughly $6.65 billion in the single month of January 2021. They later took a staggering $2.75 billion emergency injection fund from Citadel, and .72 ended the year down 39% overall and closed their doors by May 2022, never recovering from the trade. Now you know exactly what you were watching. 7 terms that come up every time short selling does. Worth knowing. Short position. You've borrowed shares and sold them, betting the price falls before you have to buy them back. Covering. Buying those shares back to close the position. Cover low, you profit. Cover high, you bleed. Short interest. The total number of shares shorted across a stock. High short interest is the fuel a squeeze needs to ignite. Days to cover. Short interest divided by average daily volume. It tells you how many trading days it would take all shorts to close their positions. Margin account. The special brokerage account required to short. The broker monitors it constantly, and if the trade moves against you, they can issue a margin call, add money now, or the position gets forced closed. Uptick rule. A regulation that only allows new short sales after a stock's price ticks up. It exists to keep shorts from piling onto a falling stock and accelerating the collapse. Regulation SHO, the SEC's primary rulebook for short selling since 2005, covering locate requirements and settlement rules. Note that naked short selling, selling shares you haven't borrowed, is illegal under this regulation. Know these terms and you can follow any short selling story without losing the thread. Strip away the mechanics and this is what's left. Most investors are directionally attached. They want stocks to go up. Up is good, down is scary, and the whole emotional system is wired around one direction. Smart money isn't wired that way. They don't care which way the price moves. They care which way the price should move based on what they know. If the research says up, they buy. If the research says down, they short. The direction is an output, not a preference. That's the real edge. Not access to better information, not faster computers, just the willingness to make money in either direction instead of waiting around for the market to do what you wanted it to do. Short selling is what makes that possible. It's the tool that lets a verdict of "this is overpriced" turn into a position, the same way "this is undervalued" does for everyone else. None of this means you should open a short tomorrow. The risk side from earlier still applies. Long positions have a floor, shorts have no ceiling. But understanding how shorting works changes how you read every market story from here on. You stop seeing only one side of the trade. You start seeing the whole board. And that's the actual point of this channel. Not stock picks, not hot takes, just understanding how money actually moves so the decisions you make over time are sharper than the average. 60 seconds. Everything we covered. Short selling means borrowing shares, selling them now, and buying them back later at a lower price to keep the difference. The mechanics work the same as the bicycle example. Borrow, sell, buy back cheaper. Return, pocket the spread. The risk is what makes it dangerous. Long positions have a floor, zero. Shorts have no ceiling. If the trade goes against you, the loss has no fixed limit. Smart money uses shorting as part of a research-driven strategy, not as a guess. Hedge funds short to stay positioned in falling markets. Institutions short to hedge. The work always comes first, the position second. Short sellers also play a structural role. They counter overvaluation, and they've exposed some of the biggest frauds in modern history. Enron, Wirecard, Luck and Coffee, sometimes years before the rest of the market caught up. And when too many shorts crowd into the same trade and the price moves against them, the result is a short squeeze. GameStop is the textbook case. Knowing how that mechanism works changes how you read the news. That's the whole picture. You now understand a side of the market most investors never bother to learn. If this video made short selling click for you in a way it never has before, good. That's what we're here to do. Hit subscribe so it lands in your feed, like the video if it earned it, and drop a comment with the next concept you want broken down this way. Most of the videos on this channel started as someone's question. See you in the next one.